When it comes to investments, we Indians have been investing in instruments like FD, insurance, PPF, gold, and real estate. But every investment has its pros and cons. For instance, while FD and PPF offers fixed interest, the returns are on lower side in the range of 6-7% today. So fixed return options like FD and PPF are good investment to conserve your capital, but they are not good for wealth creation because inflation itself in our country is 5%. Then gold is again a good option, but its historic return in the last 40 years are around 8%. Real estate is not a cup of tea for every investor because it requires a huge sum of money. That's where for a person who gets a monthly salary and willing to invest for wealth creation, one of the best options is investment in Indian economy. For instance, in the last 36 years, Sensex has generated nearly 14% CAGR return. In other words, Sensex has generated more than 100 times return in last 36 years. During the same period, an FD return would be around 15-16 times. Clearly, there is a huge difference. And considering the fact that 21st century belongs to India, there is immense growth opportunity in Indian economy. Now the question is, how to invest in Indian economy? So one of the options is direct stocks. But let's be honest, it's not a cakewalk to invest in stocks directly. You need to spend a lot of time for research and stay updated with company's performance. And if you have a job or business, it's not that easy to spend so much time. In fact, due to lack of right knowledge, many people end up losing money in stock market. That's where second option to invest in Indian economy is via mutual funds. Since every year a lot of new investors starts their investment journey, I thought of covering the basics of mutual fund because a lot of people end up investing in mutual funds without any knowledge and end up taking wrong investment decisions. So in this video, I'll cover 5 things. First, what is a mutual fund with example. Second, type of mutual funds. Then third, how mutual funds work. Fourth, pros and cons of mutual fund. And fifth, how to select the right mutual fund. Alright, let's get started. In simple language, mutual fund is nothing but a pool of money from various investors which is invested in security market by mutual fund manager. Let me try to simplify it with an example. So let's say you are saving rupees 10,000 a month and want to invest that money in Indian economy via mutual funds. So you need to select a mutual fund scheme that is managed by a mutual fund manager. Likewise, there are many people like you who want to invest in that mutual fund scheme. So fund manager will pool the entire money and will further invest that money in securities like stocks, bonds, gold, etc. Now it is the responsibility of fund manager to identify the right stocks, bonds, etc. and keep a track of their performance and eventually decide what to buy and what to sell. Now here there are a few key terms that you should be aware of. First, mutual fund scheme would be a part of mutual fund house, also known as AMC, that is asset management company. Second, let's say you invested rupees 10,000 and likewise 5 other people invested 10,000 rupee, so total investment is 60,000. That is called AUM, that is asset under management. Third, when you invest in mutual fund, you won't get individual stocks or bonds. You will get units. This unit has a price that is called NAV, that is net asset value. Fourth, every mutual fund house charges a fixed fee to manage your money. This fee is called expense ratio. It is directly deducted from your returns. For example, let's say the mutual fund scheme has generated 12% return in a year and mutual fund has, let's say, 1% expense ratio. So your final returns would be 12 minus 1, that is 11%. This expense ratio would be different for every mutual fund scheme. Fifth, whenever you invest in mutual fund, you will have to select options between direct and regular plan. Direct plan means your investment is directly done without any mutual fund agent or distributor. If you select regular plan, your investment would be via mutual fund agent or distributor. The key difference is when you opt for direct plan, you pay less expense ratio as compared to regular plan because when you opt for regular plan, you end up paying a fee to that mutual fund agent. So you can use groww platform to invest in direct mutual funds without any agent at 0% commission and get higher return than regular mutual funds. And you can also track all your mutual fund performance on this groww platform. Then sixth, every mutual fund performance is tracked against a benchmark. Again, this is very important. If a mutual fund, let's say, has generated 10% return in a particular year, then how would you say that the performance is good or bad? For that, you need to compare the mutual fund performance against the benchmark performance. Every fund manager goal is to beat the benchmark. Then seventh, there is something called SIP and lump sum investment. SIP means systematic investment plan. When you set up SIP, you invest a fixed amount on a periodic basis. For example, you can set up, let's say, 5,000 rupee to be invested every month on a specific date, let's say 1st of every month. Once you set up SIP, your investment will happen automatically on 1st of every month and amount would be deducted automatically. In addition to SIP, you can also do lump sum investment where you can do one-time investment of any amount at any point in time. Now let's take a real-world example and try to understand it better. So on the screen, you can see mutual fund scheme called Kotak FlexiCap Fund and is a direct plan. As discussed, you have two options, direct versus regular, and it's a direct one. Then it is a growth plan. So again, you have two options for every scheme, growth versus dividend. When you opt for growth plan, your dividend received from stocks would be reinvested. And when you opt for dividend, you get the dividend in your account. Now, if you are investing for long term, it's better to opt for growth plan. Next, if you click on the icon, it will show you the AMC name. In this case, the AMC is Kotak Mutual Fund. That is an equity fund, and within equity, its subcategory is FlexiCap. We'll discuss the various types of mutual funds shortly. Now, when you scroll down further, you will see the returns of this scheme over the period of 1 month, 6 months, 1 year, 5 year, etc. Then you can see the latest NAV, that is net asset value of this fund. Minimum investment amount is 500 rupee and fund size, that is AUM of the scheme, is more than 35,000 crore rupees. So a total of more than 35,000 crore has been invested in this particular scheme. Then if you scroll down further, you can see the holding of the scheme. You can also see sectoral breakup and a lot of other data points. Next, the scheme has an expense ratio of 0.68% and its taxation is 15% if you redeem before 1 year, and after 1 year tax is 10% on profit above 1 lakh. Then you can even find fund manager detail who is managing this fund. Then you can find fund house details and its investment objective. Now the next question is, how do you know if a mutual fund scheme would invest in equity or bond or gold or a mix of all of them? So let's understand various types of mutual funds. Broadly, mutual funds can be categorized in three major segments: equity, debt and hybrid. Equity mutual fund invest money in individual stocks, debt mutual fund invest money in bonds, and hybrid mutual fund invest in both individual stocks and bonds. Now, each of these categories are further divided into many subcategories. For example, equity mutual fund is subdivided into contra, dividend yield, ELSS, focused, large cap, mid cap, multi cap, small cap, sectoral, value and flexi cap. And each subcategory has multiple schemes from various fund houses. Then there is something called index fund. Now, mutual funds can be divided into two categories based on the investment style. First is active mutual fund and second is passive mutual fund or index fund. In active mutual fund, the fund manager would actively buy and sell securities with a goal to beat the benchmark. Whereas in passive mutual fund, that is index fund manager just need to replicate the benchmark. Now, I don't want to discuss this further as it would get too complicated. I'll create a separate video on mutual fund versus index fund and which is better. Let me know in the comments if you want a separate video on this topic. Now, coming back to subcategories, debt mutual fund again has many subcategories like banking and PSU, corporate bond, credit risk, dynamic bond, gilt, liquid fund, long duration, low duration, medium duration, overnight, etc. And hybrid mutual fund again has various subcategories like aggressive hybrid, balanced hybrid, conservative hybrid, etc. Now let us try to understand how mutual funds really work. So far we have understood that multiple people invest their money in mutual fund schemes that is managed by a mutual fund manager. Now the question is, how mutual funds really work? How do you get returns from mutual fund? And what kind of returns can you expect from mutual funds? So first of all, when you invest in a mutual fund, you get unit based on the NAV of that fund. For example, let's say you invested rupees 10,000 in a mutual fund scheme and its NAV is, let's say, 80 rupee, then you will fetch 10,000 divided by 80, that is 125 unit. Now the returns from mutual fund would vary based on the performance of securities within that scheme. For instance, in our previous example, Kotak FlexiCap Fund had 48 stock holding in its portfolio like ICICI Bank with 9.5% weightage, Infosys with 5.8%, then L&T, SDFC Bank and so on. It means out of 100 rupee, 9.5 rupee would be invested in ICICI Bank and likewise. So ultimately, Kotak FlexiCap Fund return would depend upon the returns from those 48 stocks in the portfolio as per the weightage. If the underlying stock price increases, the NAV would increase, and if the stock price fall, NAV would fall. Now let's say after a year, NAV of that fund has increased from 80 rupee to 100 rupee. Since you purchased 25 units, your investment value would become 125 into 100. That is 12,500 rupee. And in terms of return, it would be 25% return. Likewise, if the NAV falls from 80 rupee to 70 rupee, then your returns would be minus 12.5%. Please note that in equity mutual fund, the returns would be volatile in the short term and it can be negative as well. And when I say short term, it could be 1 year, 2 year. But in the long term, equity mutual fund would generate much better returns. Likewise, when you do SIP investment, you can add the total units that you would buy every month and then multiply it with latest NAV to get your investment value. Now let us try to understand the pros and cons of mutual fund. Let's first cover the pros of investing in mutual fund. First, investment is managed by experts who have extensive knowledge of the market. You don't have to take the hassle of doing research and identifying where to invest and when to invest, etc. Second, much better return potential. If you opt for equity mutual fund, the return potential in the long term is much better than the other options in the market. You can easily fetch double-digit return and can easily beat the inflation in the long term. Third, transparency. Another very important feature of mutual fund is you can always track the performance of your mutual fund and can see where the fund manager is investing your money and how much fee the fund house is charging from you and what are the other risk aspects. So there is clear transparency. You can choose the mutual fund as per your preference. Then fourth benefit is diversification. If you opt for equity mutual fund, your money is invested in multiple stocks and sectors, so that reduces your risk by diversification. So even if few stocks doesn't perform, the performance will be balanced by another set of stocks. Then fifth benefit is liquidity. You can sell your investment at any point in time. There is no lock-in period except for tax-saver mutual fund. Although in equity mutual fund you should always invest for long term, but there is no lock-in that makes mutual fund highly liquid instrument. Then sixth benefit is taxation. When you invest in equity mutual fund for more than 1 year, you only have to pay 10% tax, that too on profit above 1 lakh. For example, you invested 5 lakh rupee and your total investment value after 1 year is 6 lakh. Then you don't have to pay any tax. If your investment value becomes, let's say, 10 lakh, then you have to pay 10% tax on remaining 4 lakh, that is 40,000 rupee. Although in debt mutual fund, now you have to pay income tax as per your tax slab. Then seventh option is you can start with as low as 500 rupee. You don't need a huge capital to invest your money in mutual fund, and that again makes it a very attractive option for investors. Now if you look at the cons, first is volatile return. Mutual fund returns are not fixed. Returns depend upon market condition and degree of volatility depending upon your mutual fund category. Second is cost. Mutual fund house charges a fee, that is expense ratio, to manage your money. So mutual fund investment is not free. Again, this cost would vary from scheme to scheme. Then third disadvantage is exit load. Some mutual fund charge exit load if exited before a specific period. Although there are very few mutual funds that charges exit load. Then fourth is diversification reduces profit. While diversification on one side help you reduce risk, on another side the returns are restricted due to diversification. Now that you got a good understanding of mutual funds, let us try to understand how to select the right mutual fund. When it comes to mutual fund investment, there is no one-size-fits-all approach. Always remember that. One of the common mistakes investors do is they simply invest in mutual funds where their friends or colleagues have invested. Please note that every person has a different risk appetite and financial goal. So first of all, before you shortlist any mutual fund, you need to identify your risk profile. Are you a risk taker or a conservative investor? To get this answer, just ask yourself, would you be okay if the mutual fund you have invested falls 20-30%? So if you have low risk appetite, then equity mutual funds might not be a right option for you. Hybrid or debt mutual funds are better for conservative investor. However, equity mutual funds are better for a person that has a high risk-taking appetite. So if you can take volatility in your portfolio, then equity mutual funds are better for you. The problem is that everyone wants high return with low volatility, but that is not possible. Second aspect is investment goal. If you have a financial goal of, let's say, 5 years or more, like your children higher education or say retirement planning, then you can invest in equity mutual fund. If you have say 2-3 years of investment horizon, then you should not invest in equity mutual fund. In that case, you can consider debt or hybrid funds. So your mutual fund selection would depend upon your risk-taking appetite, that is appetite to handle volatility, and your financial goal. Now the most common mistake investors make in mutual fund is they select the mutual fund based on past 1 to 3 years of performance. But the problem is, if a mutual fund has outperformed in the past, there is no guarantee that it would continue to outperform in the future. So don't just chase past return blindly. Once you know whether you want to invest in equity or debt or hybrid mutual fund, you need to shortlist subcategory and then consider multiple parameters like mutual fund past performance, expense ratio, portfolio breakup, fund manager detail, AUM size, etc. and then take a call on right mutual fund selection. So if I quickly summarize, in this video we discussed what is a mutual fund, type of mutual funds, how mutual funds work, pros and cons of mutual fund, and how to select the right mutual fund. I hope you'll find this video useful. In case you want me to cover any specific topic on mutual fund, let me know in the comments. And if you want to invest in mutual funds, you can download groww app. I'll see you in next video. Till then, take care.